Welcome to NHK New-us. In recent months, a bold economic claim has circulated through headlines, speeches, and opinion pages that U.S. trade policy successfully slashed the monthly trade deficit by 77%. At first glance, that number sounds transformative. A 77% reduction suggests a dramatic correction of one of America's most persistent economic imbalances. It implies strategy, control, and measurable success. But before we accept the headline, we need to understand what the trade deficit actually represents, and why a single monthly figure can be deeply misleading. The trade deficit is not simply a scoreboard of winning or losing. It measures the gap between what a country imports and what it exports. When imports exceed exports, a deficit appears. That number reflects millions of decentralized decisions. Businesses sourcing components, consumers buying products, investors moving capital, energy markets shifting, and currencies fluctuating. In other words, it is not a policy switch that can be flipped overnight. It is the outcome of complex global flows. So when a 77% drop is announced, the first useful question is not, is that good? But rather, compared to what? The figure in question refers to a single month, October, when the U.S. trade deficit dropped sharply compared to a previous peak earlier in the year. Measured from that earlier high point, the decline appears dramatic, but economics is rarely about isolated peaks. Trade patterns are seasonal. They move in waves. Businesses import heavily ahead of holidays. Companies stockpile goods in anticipation of tariffs. Energy prices shift month to month. When you compare a temporary spike to a temporary dip, you can produce impressive percentages without demonstrating long-term structural change. For viewers and listeners, this is an important lesson in economic literacy. Percentages can amplify volatility. A sharp rise followed by normalization can look like a collapse. A temporary distortion can appear as policy triumph. Context determines meaning. Another essential layer is timescale. Month-to-month comparisons tell one story. Year-over-year comparisons tell another. Multi-year structural trends tell yet another. When evaluating trade policy, the critical question is not whether one month improved, but whether the overall trajectory changed. Did domestic production sustainably rise? Did export competitiveness improve? Did supply chains permanently shift? Or did short-term adjustments temporarily distort the data? This distinction matters because trade deficits are influenced by factors beyond tariffs. Currency values play a central role. A weaker dollar makes imports more expensive and exports more attractive, naturally narrowing the deficit without any change in industrial capacity. Consumer demand also matters. If domestic spending slows, imports often fall. That reduces the deficit, but not necessarily for healthy reasons. A shrinking deficit caused by economic slowdown is very different from one caused by productive expansion. There is also the capital flow dimension. The United States attracts enormous foreign investment. When foreign investors buy U.S. assets, from treasury bonds to technology stocks, capital flows into the country. That inflow strengthens the dollar and often increases the trade deficit as imports become cheaper. In that sense, the trade deficit is partly a mirror of America's role as a global financial hub. Reducing it is not simply about restricting imports. It involves rebalancing deep financial structures. For business owners, policymakers, and informed citizens, the real value lies in distinguishing signal from noise. A single dramatic percentage does not automatically indicate industrial revival. True structural change would show up across employment data, manufacturing output, capital investment, and long-term export performance. It would persist across quarters, not just appear in one statistical snapshot. At NHK New-us, our mission is not to amplify claims, but to examine foundations. The 77% figure captures attention. But attention is not the same as transformation. To understand whether trade policy truly reshaped the American economy, we must go beyond the headline and explore what actually moved beneath the surface. In Part 1, we examined why a dramatic percentage can capture attention without necessarily proving structural change. Now, in Part 2, we go deeper. How exactly was the 77% reduction calculated? And why does that calculation matter? The headline figure came from comparing October's trade deficit to a much higher point earlier in the year. On paper, the drop looked extraordinary. But economics is not just about the size of change. It is about the starting point you choose. Imagine measuring your weight the morning after a holiday feast, then again after a week of dieting. The percentage drop may look dramatic, but it reflects a temporary spike rather than a long-term trend. Trade data behaves in a similar way. Monthly figures fluctuate due to shipping cycles, commodity prices, inventory adjustments, and seasonal demand. Selecting the highest month and comparing it to a low month naturally produces a large percentage swing. When economists look at trade performance, they typically examine three perspectives: month-to-month movement, year-over-year comparison, and cumulative totals over longer periods. Each perspective tells a different story. Month to month, the decline in October was significant but far smaller than 77%. Year over year, the drop was noticeable, but again more moderate. And when the following month's data arrived, the deficit rebounded sharply. That rebound is crucial. If a reduction disappears the next month, it suggests volatility, not structural correction. This is where statistical framing becomes powerful. A year-to-date compared to a peak comparison can sound impressive because it compresses a complex pattern into a single dramatic percentage. But trade deficits are not linear lines trending smoothly downward. They are jagged movements shaped by global supply chains. Another important factor is the nature of imports themselves. Not all imports represent weakness. Some imports are raw materials and components that American factories depend on to produce exports. When imports of industrial inputs fall, that does not automatically signal strength. It can sometimes indicate slower production or inventory adjustments. Moreover, businesses often act strategically around policy uncertainty. If companies expect tariffs, they rush to import goods before those tariffs take effect. This behavior, known as front-loading, temporarily inflates the deficit. When the feared tariffs do not materialize or are delayed, imports fall sharply because firms already have stocked inventory. The deficit then narrows, but not because domestic production suddenly surged. Instead, it narrows because prior behavior pulled future imports forward. This dynamic is essential for listeners to understand. Trade numbers can be distorted by timing. If you only look at the month when imports fall, you may miss the months when imports surged beforehand. The apparent improvement may simply be a correction. So what should we watch instead? Sustainable trade improvement would show consistent export growth, expanding manufacturing output, rising productivity, and long-term diversification of supply chains. It would not depend on one category of goods or one unusual month. It would persist even after seasonal adjustments and policy uncertainty fade. At NHK New-us, we encourage viewers to ask one critical question whenever they hear a dramatic economic statistic. Is this a trend, or is this timing? Because in global trade, timing can create headlines, but trends define reality. In Part 2, we examined how the 77% figure was framed. Now we move to a deeper question. What actually caused the October drop in the trade deficit? Because when we dissect the data carefully, the answer is far more specific and far less dramatic than the headline suggests. The sharp decline was not broad-based across the entire U.S. economy. It was heavily concentrated in just two categories: pharmaceuticals and gold. At first glance, that may seem surprising. Gold is not a major consumer product, and pharmaceuticals represent a specialized sector. Yet both categories are highly sensitive to global uncertainty and policy expectations. They are also prone to large, irregular transactions that can swing monthly trade data significantly. Earlier in the year, businesses feared that new tariffs might be imposed on certain imported goods. In response, many companies accelerated their purchases. This behavior is known as front-loading. Firms rushed to import products before potential tariffs could raise costs. As a result, imports surged during those earlier months, artificially inflating the trade deficit. Then something important happened. Expectations changed. Some feared tariffs did not materialize or implementation timelines shifted. Companies that had already stocked up no longer needed to import at the same pace. Instead, they began drawing down existing inventories. Imports fell sharply, especially in categories that had been heavily front-loaded, including pharmaceuticals and precious metals. Mathematically, this created the appearance of a dramatic correction. But economically, it was not a sudden industrial revival. It was an inventory cycle unwinding itself. Gold adds another layer to the story. Gold trade flows often respond to financial market volatility rather than consumer demand. When investors feel uncertain, gold movements can spike. Large institutional transactions can inflate import figures one month and reverse the next. These swings can distort trade balances without reflecting underlying production strength. For listeners trying to extract practical insight, this distinction is crucial. A healthy structural improvement in trade would typically involve broad expansion in export sectors, machinery, technology, agriculture, energy, alongside rising domestic production. Instead, the October decline was concentrated in a narrow set of volatile categories. This reveals an important economic lesson. Not all deficits are equal, and not all improvements are structural. When a trade balance narrows because businesses stop importing after stockpiling, that is a timing adjustment. It does not necessarily mean domestic factories have replaced foreign suppliers. It does not necessarily mean American workers are producing more goods. It does not automatically signal that supply chains have been reshored. In fact, if you examine cumulative trade figures across the broader year, the total deficit remained elevated compared to previous periods. That context challenges the narrative of sustained correction. There is also a psychological dimension here. Markets respond to uncertainty. When policies are unpredictable, companies hedge their risk by altering purchasing patterns. These defensive moves create volatility. Volatility, in turn, creates dramatic percentage swings. But volatility is not the same as progress. For business leaders and policymakers, the takeaway is strategic clarity. Trade data must be interpreted alongside inventory trends, commodity flows, and policy expectations. A narrow monthly improvement driven by specific goods cannot substitute for long-term competitiveness. At NHK New-us, our goal is to move beyond surface-level statistics and ask, what changed beneath the surface? In this case, the answer points less to structural economic transformation and more to temporary inventory correction amplified by volatile sectors. So far, we've examined the headline, the calculation, and the short-term drivers behind the trade deficit's temporary drop. Now we confront the central promise behind the policy. Were tariffs meant to simply adjust monthly trade numbers, or to fundamentally rebuild American industry? The broader objective was clear. Tariffs were framed as a tool to reduce reliance on foreign imports, revive domestic manufacturing, and restore industrial jobs. The theory was straightforward. If imported goods become more expensive, American companies and consumers will shift toward domestic production. Over time, factories would expand, supply chains would reshore, and manufacturing employment would grow. But economic systems rarely respond in such a linear way. One major challenge lies in modern supply chains. Today's manufacturing ecosystem is deeply globalized. American factories do not simply compete with foreign producers. They depend on them. Many U.S. manufacturers import intermediate goods, specialized components, raw materials, electronics parts that are essential to producing finished American exports. When tariffs increase the cost of these imported inputs, domestic production costs also rise. This creates a paradox. A policy designed to protect domestic industry can unintentionally weaken its global competitiveness. If U.S. producers face higher input costs, their products become more expensive on international markets. Exports may struggle, offsetting any reduction in imports. There is also the currency dimension. Trade balances are closely tied to exchange rates. When the U.S. dollar weakens, exports become more affordable for foreign buyers, and imports become more expensive for Americans. This naturally narrows the trade deficit, regardless of tariffs. In periods of policy uncertainty or global volatility, currency shifts can play a larger role than trade barriers themselves. If the recent narrowing of the deficit coincided with a weaker dollar, then the improvement may reflect currency adjustment rather than industrial revival. For viewers seeking clarity, this distinction matters. Structural manufacturing growth looks different from currency-driven statistical change. Another measurable indicator is employment. If tariffs were successfully reindustrializing America, we would expect sustained growth in manufacturing jobs and rising factory output. Yet broader employment trends in manufacturing have not shown a dramatic resurgence. In fact, the sector continues to represent a historically small share of the total workforce compared to previous decades. This does not necessarily mean tariffs have zero effect. Some industries may benefit from temporary protection. Certain domestic producers may gain breathing room. But long-term industrial competitiveness depends on more than price barriers. It requires productivity gains, technological investment, workforce development, infrastructure modernization, and supply chain efficiency. Protection can buy time. It does not automatically create innovation. For business leaders and policymakers, the strategic question becomes, is the objective short-term trade balance optics or long-term industrial strength? These are not always the same goal. A trade deficit can shrink during economic slowdown. It can shrink because consumers spend less. It can shrink because imports fall faster than exports. None of those outcomes necessarily signal industrial renewal. At NHK New-us, we encourage our audience to focus on structural indicators: capital investment, productivity growth, export diversification, technological leadership. These metrics reveal whether policy shifts are reshaping the economy or merely reshuffling monthly numbers. In this final part, we step back and examine a deeper economic tension, one that goes beyond monthly statistics and even beyond tariffs themselves. On one hand, the goal is to reduce the trade deficit. On the other hand, the United States continues to actively attract foreign investment into treasury bonds, technology companies, real estate, manufacturing plants, and financial markets. At first glance, these two objectives seem compatible, but economically, they are often in tension. To understand why, we need to look at the balance of payments, the broader framework that connects trade flows and capital flows. When foreign investors send money into the United States to purchase assets, they must convert their currency into dollars. This increases demand for the US dollar, often strengthening it. A stronger dollar makes imports cheaper for American consumers and businesses, while making US exports more expensive for foreign buyers. The result? The trade deficit can widen. In simple terms, capital inflows tend to support trade deficits. This is not necessarily a sign of weakness. In fact, it often reflects confidence in the US economy. Investors around the world view American markets as stable and attractive, but that very attractiveness makes eliminating the trade deficit more complicated than imposing tariffs. There is also a deeper structural reality. The US economy is heavily consumption-driven. American households and businesses demand a vast range of goods: electronics, clothing, machinery, raw materials, many of which are produced more cheaply abroad. Reducing imports without reducing demand requires replacing global supply chains with equally efficient domestic production. That transition is complex, costly, and slow. Moreover, if policy uncertainty rises, global investors may hesitate. Ironically, uncertainty can weaken the dollar in the short term, narrowing the trade deficit temporarily. But that narrowing would stem from volatility, not from productive expansion. In that scenario, a smaller deficit might reflect instability rather than strength. This brings us to the core lesson for viewers of NHK New-us. Trade deficits are not isolated scorecards. They are deeply intertwined with capital markets, currency dynamics, consumer behavior, and global confidence. Reducing a trade deficit sustainably requires more than tariffs. It requires enhancing competitiveness, investing in advanced manufacturing, strengthening supply chain resilience, expanding high-value exports, and increasing productivity. It may also require accepting that in a financially dominant economy, persistent trade deficits are structurally linked to global capital leadership. The October decline made headlines. The 77% figure captured attention. But long-term economic transformation cannot be measured by a single month. Real structural change would mean consistent export growth across multiple sectors, rising manufacturing productivity and innovation, increased domestic investment in advanced industries, supply chains that are resilient, not reactive. As we conclude this analysis, the central question is not whether the trade deficit briefly narrowed. The real question is whether the foundations of the economy have shifted in a durable way. At NHK New-us, our commitment is to clarity over slogans, context over headlines, and long-term perspective over short-term volatility. Because in global economics, numbers can move quickly, but structural change moves slowly. And that is where the real story lies.